£100 per week invested into the stock market really doesn't sound like much. But how about with your £100 per week investments allowing you to be able to afford this £950,000 mansion and a brand new McLaren GT for £130,000? Well, if you invest that £100 per week at a 9% annual rate of return, you will eventually end up with £1.9 million. So that's 1.1 million spent on a house and a car, and that's £800,000 left over for you guys to live like kings. Now, whilst that's not exactly how investing in the stock market works, and yes, there are other factors at play here, such as inflation and house prices increasing, what I am going to do throughout the course of this video is give you a 6-step process on how you guys can actually build a multi-million pound investment portfolio over the long run, which will certainly help some of you guys achieve your financial goals. But before I do so, guys, my name is Mitch. I post all kinds of videos on investing in the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a thumbs up on the video, guys. It really does help out the channel. And with that being said, let's dive straight into it. Step number one being have £100 a week to be able to invest. So firstly, it's important for you guys to actually have that £100 per week in surplus cash or disposable income to be able to actually invest into the stock market. And whilst that's easier said than done, here are a few suggestions that you guys can look towards in order to be able to find that £100 per week within your current monthly budget. The first one being cut back on those little luxuries when you're going down to Asda to do your weekly shop. Those couple of packets of extra chocolate bars as well as those couple of bottles of wine really do add up over the course of a month. Secondly, go onto comparison websites like GoCompare to see if you can swap bill providers in order to bring down your overall monthly household expenses. I did it this year and I was able to save over £300 just on my gas and electric. Number 3, don't get sucked into buying new iPhones every time that your phone tariff has expired or your contract finishes. Instead, perhaps look at keeping the same phone and actually just going on to a cheaper tariff to save those few extra pounds. Number 4 is to look at your car payments or your car situation. If you're either driving around in a brand new car or if you've got a big loan in which you're paying off every single month to be able to afford that car, and you can't afford to invest £100 per week into the stock market, inevitably you need to get a cheaper car. If none of those small little personal finance tips are able to get you to that extra £100 per month in disposable income, go onto Google, type in some of the other budgeting or frugal living type hacks that will allow you to be able to generate that extra £100 per week. Or on the other hand, if you cannot look to cut your expenses, the alternative is to actually just increase your income. So go for that promotion at work that you've always wanted, start a side hustle, or even start a YouTube channel, anything that will allow you to generate a little bit of extra cash in order to be able to set yourself up financially for the future by investing into the stock market. Because the reality is generating an extra £100 per week really is achievable for absolutely anybody if you do put your mind to it. And that leads me on to step number 2, which is to have a 3 to 6 month emergency fund in place. Now, this may sound like a really boring topic to actually discuss, but it's such an important one. It's one of the core personal finance principles that I personally believe in and believe that everybody should look to adopt this habit as and where they can to achieve an ever greater level of financial security just by having 3 to 6 months worth of their monthly expenses saved up in cash ready for a rainy day. If anything, it really does just buy you an element of time. If you end up unemployed for whatever reason, if you have a big expense that you're not expecting, it allows you to have that cash security to be able to pay out for those expenses if you do have 3 to 6 months worth of a cash buffer built in place. So getting your personal finances in order prior to investing in the stock market is an absolute must. Now, interest on savings accounts are pretty terrible across the board right now. However, you can go onto moneysupermarket.com and you can scroll through the list of all the different savings accounts to try and maximize the interest in which you could possibly earn. Step number 3 is just to get some background knowledge on the topic of investing. And yes, this is 10 or 11 books in which I've read on the topic of personal finance and investing, and I can't stress the importance of this enough for you guys to actually just go and study, go and read some of these books like the ones that you can see here. So we've got The Intelligent Investor, we've got Tony Robbins' Money Master the Game, we've got Ray Dalio Principles, we've got loads of good solid books here which will allow you to build the right foundations, the right knowledge when you're looking to invest in the market. Because as Warren Buffett once said, risk only comes when you don't know what you're doing. And whilst I've spent the best part of the past 6 or 7 years actually reading and studying, investing in the stock market and all of the topics that go with it, I still have a lot more to learn. However, by reading these books, it allowed me to feel prepared when I did start to invest into the stock market. Not only was I perfectly in tune with what my risk appetite was, but what my investment objectives were too. And once you do get to that place of comfort, which you inevitably will do once you've digested all of this knowledge, that's probably the best time for you to be mentally prepared to actually invest into the stock market. And if you're not too sure where to start, pause the video right now, take a look at this list of 11 different books and buy a couple of them and just get started. Step number 4 is actually just knowing where to invest. Many different people take different stances when it comes to investing, depending on their capital availability, their risk appetite, as well as their stage of life too. For me personally, I'm looking for capital growth within my portfolio, and that kind of dictates what I kind of invest into. So as an example, the S&P 500 ETF that I hold with Vanguard, I know historically provides a 9.8% annual average rate of return, as well as the other stocks in which I've invested into like AMD, Amazon, Apple, Tesla, and Facebook. I know have good solid returns over the course of the past few years, and I'm hopeful that those returns will be consistent over the course of the coming years to come as well. However, if you are later on in life, perhaps you want to stabilize your portfolio a little bit, perhaps even live off the portfolio itself. You can do this by investing in other asset classes such as bonds, which will not obviously provide you worldly returns. However, it will provide an element of stability within your investment portfolio. Or simply put, you could transition your strategy over to dividend income if you have a hell of a lot of money at your disposal that you've invested into the stock market and you simply just want to draw an income from it. So one quote that I will leave you guys for step number 4 is as follows: investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Moving on to step number 5, which is to be consistent. Once you guys have figured out what you want to invest into, be consistent with your investments. This approach or this investment strategy is also known as cost averaging into the stock market. And it's a strategy in which I use to actually invest into different stocks in which I have within my portfolio every single month, because consistency will inevitably drive growth. For perspective, here's the Vanguard portfolio in which I've built, which started off literally with £400 in the account, and then consistently over time through investing into that account itself, the portfolio was up to about just over £16,000, with the stock market selling off over the course of the past few days, is now down to £15,700. So starting off with just £100 a week or £400 per month and growing that into a £15,000 or £16,000 portfolio over on Vanguard. And then when you add in my trading 2-on-2 portfolio as well, we're talking well over a £20,000 portfolio that I've built just from taking small, consistent action on a month-by-month basis. So that's step number 5. Moving on to the final step, step number 6, which is to think long-term. One of the famous quotes from Albert Einstein on compound interest, which I absolutely love: "He who understands it earns it, he who doesn't pays it." And this couldn't be more true, because if you look at the likes of Warren Buffett's net worth growth over the course of his lifetime, what you will see is that the bulk of his net worth gain came in the latter years of his life. And I say that like he's dead, he's still alive, the last few years in which he's been alive. Warren Buffett's net worth grew more in the last 4 years alone than it had done during the first 70 years of him living on this planet. So putting that into perspective, year 1, year 2, year 5, even probably up to year 10, you will see slow, steady growth on your portfolio. It's not going to be anything fantastic if you're investing in kind of stable asset classes. However, over 15, 20, 30, 40 years, that's when the compound effect will really take place and you'll see exponential growth in your investment portfolio. And by the time you hit 40, 50, perhaps even older, if you do start investing early enough, you will see huge financial benefits from doing the small, consistent habits of £100 per week into an investment portfolio. And not only will that positively affect your life, but without a doubt, it will positively affect the lives of the loved ones in which you have around you. So that's simply how it goes, guys. These are the principles in which I've simply followed to build a £25,000-ish investment portfolio over the course of the past 3 years. If you guys apply the same principles, I'm confident that not only will you be able to achieve a £25,000 portfolio in a relatively short space of time, but you'll also be able to achieve far greater goals than that, in which I'm sure all of you have. Let me know down in the comment section, guys, what your investment goals are for the future. And with that being said, if you did enjoy the video, guys, be sure to smash a like on it, as well as subscribe to the channel if you're new around here. And with that being said, I will see you over in the next video.